And to keep things moving, we're very excited to have Robert Dietz again, one of KCMA's favorite speakers. He's a PhD and he's the NAHB Chief Economist. And with that, I'm just going to let Robert take it away.
Yeah, thank you, Mike. It's good to be able to join this group again. I think I was with you in April in person. I've got an update of our housing and economic outlook. Most of the revisions have been to the negative side. So if you saw me in April or at any other recent events, we keep chasing the forecast down. And the reason for that, higher rates and higher inflation. The expectation that the Federal Reserve would be able to combat inflation and slow kind of the path of monetary policy induced higher interest rates. I think that hope has been reduced, and I'll give you kind of the outlook in terms of where I think the overall economy and the housing market's going, and I'll make sure that Mike and Betsy and the team at KCMA have a PDF copy of this deck if you want to take a look at the slides afterwards. We'll go through the presentation. It's got 3 sections. Macro outlook, some of the supply side concerns we're watching from the builder perspective, and then I'll end with our forecasts. If you have questions, type them into the chat or the Q&A function, and Mike will read those to me at the end of the discussion. So here's our kind of headline findings. The Federal Reserve is aggressively tightening monetary policy. I think we all know interest rates surged at the beginning of this year. There's often a competition for, who's the better forecaster, or maybe we should say the worst forecaster, economists or weathermen. At least weathermen can tell you if it's raining right now. The challenge with the economics profession is we can't even get agreement on whether the economy is in a recession right now. Now, it's partly academic. We know at the start of the year that the economy declined for 2 straight quarters. It did not see a rise in the unemployment rate. So the academic types who label the official recession periods basically said, no, we're not in a recession. That's kind of in the eye of the beholder. From a housing perspective, from a business economist perspective, we definitely had a soft patch at the first half of 2022. And that's why in my second bullet point, I say our forecast includes a recession, but it's just kind of, an academic call of whether you want to say it started at the start of 2022 or it's going to continue into 2023. All the ingredients are going to be there. It's just the order of events is a little bit distorted due to coming out of the COVID situation. I'll give you the details on that. We think overall, though, it's a mild downturn, a mild recession. Inflation is obviously near 4-year highs. Got an inflation report this morning. It did not come down as much as Wall Street wanted. That's the reason the stock market's down today, and the reason the 10-year Treasury rate has moved higher on the expectation that the Fed has more work to do to fight inflation. So since I saw you last forecast update since April, the big change you're going to notice is we've got a bigger decline for single-family home building. Now, in my discussion with you all at your event in April, I think I sort of said, here's what's on the slide. This is the official forecast, but I had been doing some analysis that suggested we would see a greater than 10% decline in single-family starts. We brought that outside analysis forward into the forecast, and you'll see that reflected at the end of the presentation. So overall, single-family starts are going to weaken this year. Multifamily is still going to grow, although we think that is going to ease by the time we get into 2023. And remodeling is going to be fairly solid. The remodeling behavior is being propelled by home equity gains, the fact that people are going to move less frequently because they don't want to lose those low mortgage interest rates they have on existing mortgages. And then, of course, the demand for new space, more space in new homes continues. And, if you're in an existing home, the way you get more space is remodeling. So we continue to think that one sector is going to emerge through this recessionary period, this higher interest rate period, and grow, unlike single family and multifamily construction, which will both post some kind of cyclical decline. Housing affordability is going to continue to go down. That's working against the demand side of the industry. And then just thinking about the geography of where home construction is going to take place, the race continues to be on in terms of looking at those communities that can add housing stock, particularly entry-level housing stock, most cheaply. Those are the places we're going to see growth. And in fact, you see that right now in the sense that single-family home building declines appear to be concentrated in high-cost markets and some of the more solid areas. Not to say they aren't seeing declines, but they're not seeing the size of declines that we see in some of the hot markets of the mountain states or coastal markets. Our markets in the Midwest, and they're going to see smaller price drops and smaller single-family home building declines. All right, so let's start with the GDP outlook. We had declines in the first 2 quarters of 2022. You can see that in terms of those blue bars just to the left of that vertical red line. 2 quarters of decline, that usually is the typical rule of thumb definition of recession, although the academics don't want to call it as one. As I said at the beginning, I'm kind of in the camp to say that looks an awful lot like a recession. And then you combine it with what we think is coming, which is a bit of an uptick in the 3rd quarter, and then weakness at the end of this year and the first half of 2023, all combined basically from the start of 2022 through maybe the middle of 2023. Academics are going to go back and look at it and say, yeah, that was a recession. We had GDP declines, and ultimately we're going to have higher unemployment. In fact, we probably have now already passed the lowest unemployment rate that we're going to have for this cycle. Now, I said at the beginning that it's a bit of a timing issue. What's going on with the timing issue? Well, academics typically want to see GDP declines and a rise in the unemployment rate at the same time in order to declare a recession. Well, we're not getting that. And the reason why is that we're still getting job growth, above trend job growth, because of the fact that we essentially destroyed millions of jobs during the COVID lockdowns. So catching up, the recovery, particularly in the service sector, is leading to net job gains, and it's overwhelming the job losses that would ordinarily have been seen from these GDP declines that we had at the start of the year. So it's basically you've got multiple cycles all compressed very quickly. The recession of 2020 and then the rebound from that recession, combined with now an interest rate inflation-induced recession occurring in this 2022-2023 period. As I said earlier, I think when the academics look back, they will say this entire period qualifies as a recession. They're just not going to do that right now. Now, some of the weakness, we had a lot of government spending that really pushed up the size of the government debt. The blue line here is the size of the federal debt as a share of GDP. But that stopped. So all that stimulus that we pumped into the U.S. economy, the lack of it right now, the end of that money being pumped into the system is acting as a headwind on consumer spending. And so that's one of the reasons that we're seeing slowing growth here in 2022. The damage has been done nonetheless. That blue line jumping from roughly about 75% debt to GDP ratio to above 100% debt to GDP ratio. That's another reason that we see higher elevated inflation data. The fact that the federal government is now fiscally constrained with these higher debt levels mean that we're going to face higher nominal interest rates. And then I said just earlier the fact that we're still recovering from the COVID era job losses. And in fact, just as of July, we finally got back to the level of payroll employment, in other words, the number of jobs in the U.S. economy that we had in February 2020. So about 152 million jobs. You can see the sharp drop in terms of jobs. We lost more than 20 million jobs during the spring of 2020 due to those lockdowns. And then you get this V-shaped recovery, but the depth of that loss, particularly compared to like the Great Recession, which was almost a depression, it's just taken some time. And so the economy is still bringing those jobs online, and that is overwhelming any kind of net job loss that we would have seen from the GDP declines at the first half of the year. Now, we are beginning to see some evidence, though, of the softening macroeconomy and its impact on the labor market. And we're going to see that here first in terms of job openings. So the red line is the unemployment rate. As I said, I think we're probably just past the minimum point of the lowest unemployment rate that we're going to see for this cycle, which is 3.5%. The most recent reading, it jumped up to 3.7. In our forecast, we do have it gradually rising as this macroeconomic weakness and higher interest rates to affect the labor market. And we already hear from companies that this is occurring. Hiring freezes, limited layoffs, it is spreading through the economy. And to just look at the current labor market data misses that story. But is there any kind of current labor market data that indicates this weakening in our forecast is going to happen? And the answer is yes. It's in the blue line, which is the job openings rate. Now, I've told this group before, that's a good indicator of how bad the labor shortage is for the U.S. economy. And you can see in 2021, that job openings rate, which is a measure of help wanted signs and jobs that simply cannot be filled. But in 2021, that number really jumped. And so that's the reopening of the U.S. economy, despite the fact that a large number of workers had moved to the sidelines and were not looking for work. So you have a lot more open, unfilled jobs. Well, you can see it trending higher. And then just at the end of the data that we have historical data for going into 2022, that blue line begins to move down a little bit, kind of ticks up in the most recent data point. But my expectation, this is built into our forecast, is that blue line is coming down, which means the number of open, unfilled jobs in the U.S. economy is decreasing. And that's what you would expect to happen first before you have outright job losses in terms of net payroll employment. So the early indicators are there that the softening of GDP growth, net growth numbers, is now having an impact on the labor market, despite the fact that the business news is really dominated about how tight the labor market. Yes, it's tight because in terms of the levels, but it's now moving in the opposite direction. And that's consistent with what we would expect in terms of a recessionary environment brought on by tighter monetary policy. Now, one of the challenges, and I mentioned this in April, is the fact that the labor force participation rate continues to be weaker than it was going into COVID. In fact, right before COVID hit, about 63% of working age adults were in the labor force. This was down, and it's been trending lower for decades, but then it dropped down to 60% during COVID, staged a partial recovery, has trended higher, but it's still only at 62%. And in fact, for much of 2022, it's been moving in the wrong direction. So even though the labor force participation rate has staged the partial recovery, we simply do not have enough people who should be looking for jobs, just given their demographics and their age, but they're not out there looking and securing employment. And so that makes this really kind of tough labor market environment where employers say we're having trouble filling positions. And that's been true in manufacturing and construction for years. And this mismatch of people who are essentially on the sidelines, not working, not looking for work. And I put up these slides in April. I'm just including them, but I mentioned earlier the fact that the labor force participation rate has been going down for decades. That's particularly true for men. You can see after World War II in 1948, 86, 87% labor force participation rate, and been trending lower in all the decades since. You can see the COVID effect at the very end of the slide in terms of the post-2020 data, but we've got this long-term decline in male labor force participation. I've said it before, I'll say it again here. This is the saddest slide I think I've produced in my time doing housing and real estate economics. It's a real sign of social and education policy failure and a real mismatch between how we're training people and getting them attached to looking for work. And we simply need to do a better job of sending people to trade schools and community college to create a matching process between, frankly, younger men and jobs that are in demand. And, just to kind of put up the data from the opposite side of the equation, here's the labor force participation rate for women. It was increasing for up until the early 2000s. It's kind of leveled off, but the mismatch between these two impacts, declines for men, increases for women, says a lot about some of the social policy failures that we see that emanate out of the economy and then materialize in terms of things like out of wedlock births and other factors that really challenge our social policy system. So this is one that we're going to continue to watch. And I think all organizations, I know KCMA is involved in this, NAHB is involved in it, but we need to be working on worker recruitment and training because these are long-term challenges. They're not going to go away with some of the cyclical weakness that we see in the economy right now. All right, so the big issue right now in terms of the macroeconomy is inflation. Now, this is not CPI. CPI came out this morning. It ticked down a little bit in terms of the year-over-year growth rate numbers. It was as high as 9%. It's coming lower, closer to 8. We'd like to see it move down faster. It's moving in the right direction, but too slowly. And again, that's the reason the stock market is down today, because interest rates are moving higher, because the expectation that inflation's up higher for longer means the Fed is going to have to be more aggressive in fighting it. And that's bad for equity prices, and it's bad for housing demand. But this is the core PCE measure here in red. This is actually the measure that the Federal Reserve uses to set monetary policy. And kind of out of connection with the CPI data, it actually peaked in early 2022 and is now moving down. So I'm fairly confident that the CPI is going to come down. The big difference between this measure and the CPI, this one strips out things like shelter costs. In other words, rents. Rents are going to remain elevated for quite some time. They're connected to the fact that we don't have enough housing. They're connected to the fact that rents only increase in the CPI calculation when someone re-ups on a lease and their lease moves from their current rent to the actual prevailing market rent. And that's going to play out over 6 to 9 months. So there's not a lot of help that we're going to get on downward pressure on the CPI. Rent and shelter costs are sticky. They're not going to come down quickly. The core PCE measure is meant to be more of a kind of a focused look at inflation, and it's moving in the right direction. My hope is, and this is not a forecast, it's a hope, my hope is that the economists at the Federal Reserve are looking at this data point, and by the time we get to the end of 2022, it will give them some confidence to move into a more data-dependent mode and let the tightening that they've already implemented in terms of the bond market take hold, have an impact, look at where the inflation data is going down, not fast enough, but going down, and that will cause them to slow up the pace of tightening. And that would absolutely be good for housing and real estate. Nonetheless, you can see even in our forecast, that red line moving down slowly. And in the period of 2023, 2024, we still don't have it on average coming down to essentially the Fed's 2% target over a period of time. It gets down to 2% by the end of 2023 on a quarterly basis. And that might be the point at which the Federal Reserve is able to say, mission accomplished. So it's unfortunately, it is going to take some time. So what do we think the Fed then is going to do next? Well, keep in mind, the Fed has 2 tools that it's using to fight inflation. The one that gets most attention is here on this slide, and that's the Fed funds rate. That's the red line on the slide. The blue is the 10-year Treasury, which we care about because it helps determine some kinds of business financing. It helps determine mortgage interest rates. But what we think is going to happen is listed in green. We got a 75 basis point increase in July. I think it's going to be 75 basis points again in September. We had flirted with the idea of maybe it would be 50 a couple of months ago, and then we basically capitulated with the idea that inflation was going to remain higher than our initial forecasts from the first quarter. So we moved that up to 75. And what we've got happening is the Fed is essentially accelerating those rate hikes on the short-term Fed funds rate. So we think they will begin the pivot in November, only increasing by 50 rather than 75. And that'll bring that red line up to a top target rate. It's actually a range, but the top target rate of about 3.5%. So if you imagine that red line getting up about halfway between 3 and 4. Now, the 10-year Treasury, the blue line, is going to go up during that period, but the red line is clearly going to cross the blue line. And that's one type of inverted yield curve. You can construct another ones like the 10s and 2s, for example. But anytime you get an inversion of that short-term, long-term rate comparison, a recession typically will follow. And so that's why we're fairly confident that some kind of economic slowdown is in the making if it has not already occurred based on the weakness that we had at the start of the year. So the debate right now, though, is where the Fed funds rate is going to end up. The bond market had been saying as low as 3.2%. We think that's wrong. That's obviously, our forecast is saying 3.5 to 3.75, but the bond market this morning suggesting it could get up as high as 4%. So again, the reason the stock market's down is the expectation that the Fed is going to have to move higher still. Reductions, don't expect any reductions in 2023, even if the unemployment rate's going up. They're going to keep that higher rate for longer in order to bring inflation down. I think the earliest that we could see some reductions will be in 2024. When they occur, it'll be bullish for single family construction, without a doubt. Now, I said the Fed's got two policy tools. So I've been focusing on the Fed funds rate. That's again, the red line, it's the short-term instrument. But the other tool that the Federal Reserve is using to fight inflation is quantitative tightening. They're reducing the size of their balance sheet. So they hold about $7 to $8 trillion in various kinds of securities. And 2.7 trillion of that total are mortgage-backed securities from Fannie and Freddie and other government enterprises. Well, they're reducing those. They're letting them run off at about a $35 billion a month rate. So what impact is that having on the housing market right now? Well, the more that they let those bonds run off and the bonds go in the market and have to find buyers, the spread between the average 30-year fixed rate mortgage, which is at 5.9% right now, and the 10-year treasury, which is right above 3.4% right now, that gap grows. And in fact, that spread right now is about 250 basis points. Historically, it's only about 170. So quantitative tightening is raising mortgage interest rates by about 80 basis points right now. That's a lot. I do think it's going to close up. And as it does so, it's then going to feed into our forecast. So you can see on the red line, we think we're nearing, at least on a quarterly basis, a peak for the 30-year fixed rate mortgage. It's still got a ways to go to increase. And in fact, when we revise this a little further, maybe we'll push that red line up to about 6.5%, depending on some of the messaging from the Fed. But this is fairly consistent with the forecast I gave you on interest rates back in April. We thought that much of the increase was baked into the cake at the start of 2022. And then we kind of had rates going flat. Now, we've got a little bit more of a decline going into 2024. That's because we're fairly confident the economy is going to slow. And as the economy slows, investors sell stocks, they buy bonds, and that pushes long-term rates down. That does create a challenge for the Fed because they're pushing short-term rates up while these long-term rates may actually go down. Nonetheless, that's what we think is happening. And what I think we can say with some certainty is the expectation I've heard from some builders, or at least concerns, that we'll be facing a 7 or a 7.5% typical mortgage interest rate. I don't think there's any way that markets can take us there. And the reason why is if we were to see that kind of increase, it would require the blue line, which is the 10-year treasury, to get up to 4-5%. And if we were to go that high in the 10-year treasury, we would undoubtedly move from a mild recession to a more moderate recession. And that in turn then would push those rates down. So it's a really complicated interest rate environment with short-term trending factors, long-term trending factors. I think we got a little ways to go in terms of getting to peak mortgage interest rates. And then it's going to kind of level off there. And then by the time we get closer to 2024, we'll start to see some declines. And you'll see that reflected in terms of our home building forecast. I'm not going to go through all the details on this slide. It's basically the inflation rate in red, and then blue is the unemployment rate flipped upside down on the graph. But the message here is that anytime the U.S. economy, going back to the mid-50s, anytime the U.S. economy has had inflation greater than 4%, we had inflation up at 9%, and the unemployment rate below 6%, then the unemployment rate right now is well below 4%. Anytime those two things were true, a recession has typically happened because the Federal Reserve has had to come in and tighten. And those periods of time when those two things were true is marked in yellow on these graphs, and the areas in gray are recessions. So we're clearly in one of those periods of yellow, and we think a gray period is going to result out of that, and that would be a recessionary environment. All of that means, though, from a housing perspective, the housing affordability has continued to decline it's impossible for housing affordability not to decline in this kind of environment, where we've had home prices growing 10 to 20% in recent months, year over year, interest rates increasing, doubling basically at the start of 2022. And so on our affordability metric, which is the percent of new and existing home sales that are affordable for a typical family, that reading has now fallen to just 43%. That's the lowest reading since the Great Recession, so more than a decade low in housing affordability, and it's having predictable consequences for housing demand. Buyer traffic is way down, and buyers are shifting back over to the rental market due to the high cost of purchasing a home. And that's been playing out with some speed basically since the start of 2021. And unfortunately, we've got some additional declines for housing affordability ahead of us. And I've talked about prices. This graph kind of looks at new home prices, and the red is existing home prices. And again, you can see from late 2020, this real takeoff, particularly for blue, the new home prices. New home prices from kind of the start of 2020 up until their peak right at the end of 2021, that was a 37% growth rate. We didn't forecast that. In fact, we were actually concerned about price declines back in, say, March of 2020. We did think prices were going to increase, but I had no built-in forecast that had that kind of price growth. Unfortunately, what that means is the prices have gotten way out beyond what we expected, way out beyond what affordability conditions can maintain. In fact, the blue line, it's a little difficult to see, but at the very end of the slide, you can see that kind of dipping down and then increasing. It's a noisy data set, but thus far, it looks like median new home prices are actually already down 10% just in the last few months, and that's through deployment of the kinds of homes being sold and a growing share of builders instituting price cuts. In fact, right now, we estimate that about a third of home builders have instituted some kind of price cut. And then when you expand that out to various kinds of incentives, including, for example, rate buy-downs to lower the applicable mortgage interest rates, those kinds of incentives are being used probably by 80% of builders right now. So there's going to be a reset in pricing. We are not in the school of thought that says home prices won't go down. In fact, we do have price cuts, at least on a quarterly basis, into our forecast. I think it's likely that from their peak levels in terms of home prices down to their low point ultimately in the coming quarters, nationwide, we'll see probably about a 5% drop in home prices. And then some local markets, we could see up to a 20% decline in home prices. It gives me no pleasure in indicating that. Builders certainly aren't happy with that. But nonetheless, if you think about the really hot markets, a market like Boise, a market like Austin, Texas, 10 to 15% price declines in those markets is really quite justifiable, given the fact that home prices really got out ahead of where local incomes could support those kinds of price levels for housing. And, if we're talking about the geography, this is just the top 20 markets based on home price growth. I've listed there on the left-hand side of the slide. The areas in the darkest blue are the areas that we've seen the most amount of price growth over the last year. I was just in Fort Myers, Florida about a year ago. A lot of price growth there in the last year. That's a market where we could really see some price cuts. And you can see in that list, there's a lot of markets in Florida, a lot of markets in Idaho, Montana, Utah. So it's a lot of the mountain states and Florida. And the reason for that, population changes. The areas in green here are the places over the course of 2020 and 2021 saw the most amount of population growth. And so again, it's the mountain states and the Southeast that really are seeing those gains in population. So that's supporting some of that price growth. In other words, some of that price growth is permanent, but the fact that some of these markets have gotten overheated does put them at risk for above national levels of price resets as we see declines in housing prices. And then lastly, in the macro section, I think this is more long-term, but it's worth noting, if we're thinking about the rental housing market, the for-sale housing market over the next 10 to 15 years, basically since 2008, the fertility rate in the United States has been falling. And right now it stands at about 1.6 births per woman. The replacement rate is 2.05. So if it wasn't for immigration, right now, U.S. population would actually be declining. That's bad news for housing demand about a decade from now. In the meantime, we do have a housing shortfall, but the demographics are favorable right now, and they actually become a headwind by the time we get into 2030. So that's something, just in terms of thinking about the long run of housing demand, that's worth keeping in mind. All right, so we will turn over to the supply side. In terms of builder costs, this is an aggregate, so this is all the kinds of materials that builders use to construct housing. You can see a lot of price growth in terms of residential construction materials over the last 2 years. At their peak in aggregate, weighted by the type of material and how much is used in the industry, those costs were up 24% year over year. It has come down. It's come down to about 16%. And our real-time checks suggest that that 16% number, which comes out of the producer price index, which is the business-related wholesale measure of inflation that the U.S. government publishes, that 16% number is rapidly going down to the low single digits. So the ability, the pricing power, the ability to pass along higher costs is quickly getting squeezed out of the system. And frankly, that's what the Federal Reserve is intending to do. So this blue line is going to move quickly down to about 0% in the coming couple of quarters. And a good example of that is lumber costs. Lumber costs had gone up to about $1,500 per thousand board feet at the start of 2021. Kind of a hard to explain drop in the second half of 2021. Basically, builders went on strike for a period of time and led to some inventory increases. But then those prices went well up above $1,200 per thousand board feet again. Now they're coming down. In fact, they're actually, I think this morning, below $500 per thousand board feet. And that's due to the reduction in buyer traffic, the reduction in housing demand, and it's having a clear impact on the lumber market. And it's one of the factors that's causing what I showed you on this prior slide, this slowdown in residential construction material cost growth. So the lumber market is often the leader in looking at where some of this data is going, and showing clear weakness and declines in terms of prices. I just included this. This is the amount of sawmill output. It's been rising. It was insufficient for what we went through, which is the reason that we saw that volatility in lumber prices. And sawmill output's likely to go flat here in the quarters ahead. I'm going to skip this one. This is just imports. And then I talked about the labor market. These are construction job openings. I showed you a slide earlier in the presentation that was job openings for the full U.S. economy. Here it is just for the construction industry. We're short about 330,000 workers. And what I've told builders is that, yes, that red line has been trending higher. In fact, it's as high as it's ever been. This data goes back to the year 2000. It's well above the peak rate in 2006, 2007, indicating a really intense labor shortage in the construction industry. But look at the blue line at the end of the slide. So the red line is just the 12-month moving average, but that blue line is headed lower. And what I've told builders, I think it will go lower still. In fact, it could go down to closer to 2% or near the peak of the building boom in 2006, 2007. The reason for the declines, fewer construction firms putting help wanted signs out. The amount of firms that are looking to expand their labor force has diminished. Now, that's not to say we're going to have imminent job losses in the construction sector. This all occurs in the context of that multi-decade labor shortage in the industry. So some builders will hold on to workers just as a form of what economists call labor hoarding, talent retention during a period of weakness. But my expectation is the number of job openings that are advertised in the sector is going to go down. That means that the labor shortage is going to go smaller, but it's going to persist. It's still going to be above what we saw in 2006, 2007. And then by the time we get to 2024, it'll be going up again. And I think that kind of pattern is what we're going to see play out, not just in construction, but manufacturing and some parts of the retail industry as well. A little bit of softening in terms of the labor market. And then we need to get ready to continue to address the labor shortage in 2024 and 2025. And consistent with that cycle, we're seeing already impacts in residential construction wages. They were as high as 8% year-over-year growth rates just a few months ago. They've come down to about 5%, and my expectation is they will begin to slow closer in the 2 to 3% range. So I've told builders, yes, you've gotten used to having to pay more for workers. Those growth rates should shrink in the coming months. And that's a little out of tune with the rest of the economy. The rest of the economy, workers right now believe they've got the leverage right now, and so they're demanding higher wages. In leading sectors like construction, that leverage is going away for the reasons I talked about on the prior slide with respect to declining job openings. I'm going to skip this slide. It's just the fact that the sector continues to experience a deficit of worker productivity, and that does mean, actually, I'll say something about this. One of the challenges for builders is the fact that worker productivity has only grown about a quarter of what we've seen worker productivity grow for the rest of the economy. Now, what does that mean for downstream sectors and suppliers and manufacturers like kitchen cabinet manufacturers? Well, if you can make materials, you can make products that builders can buy, and you can quantify that this particular product is going to save worker time and result in more productivity growth for their construction crews, you can charge a price premium for that product, because builders are well aware of this. They're looking for anything they can do or invest in or purchase to bring worker output higher. In other words, increase sector productivity. And that's going to be true in the downturn and beyond, of course, over the next decade. I will skip this one. This is just kind of our targets in terms of construction labor recruitment. All right, so I walked you through macro and some of the demographics, some of the cost factors on the business side of the economy. Let's take a look at our forecasts. So I'll start with building material and garden equipment and suppliers and dealers. You can see the impacts here, really strong period from, say, the spring of 2020 until we get to about the start of 2022. My expectation is this red line is going to see some declines. The overall industry could see declines of 10 or 15% from peak, given what we're seeing happen in the single-family home building sector. And those declines we're already seeing on the consumer side of what goes into homes: furniture, furnishings, electronics, appliances, which is the blue line, is already softening. In fact, it's been softening since the end of 2021. So there was a big drop during COVID, a recovery above trend. It softened. And I think, unfortunately, that's likely to continue given the expectation that the unemployment rate is headed higher in late 2022 and the start of 2023. Now, I said at the beginning, the remodeling market's likely to be the most stable of the sectors of residential construction, and I'm going to stand by that. Here's our forecast for 2022. We think the overall sector is going to grow by 7%. We've got it slowing in terms of the growth rate in 23 and 2024, but still eking out positive gains. And again, people are going to remain in their homes longer. They're going to move with less frequency. And when they do that, they need to invest in their existing homes. Particularly, that's true for aging in place baby boomers who may not move to a new market for retirement. So all of those factors are going to be bullish indicators for the remodeling sector, including the fact that the housing stock in the U.S. is aging, because we haven't built a lot of housing over the last decade. So the typical home in the United States is about 40 years old. There's a lot of replacement efforts, both on the outside in terms of the structure and on the inside in terms of things like cabinets, materials, and the like. So I think the remodeling sector is going to overperform the rest of the residential construction sector in the coming years. Now, if we turn to single-family home building, this is our monthly single-family builder sentiment indicator, the HMI. It's declined for the last 8 months consecutively. So we've had this really strong period of weakness. You can see the blue line falling. It basically reached a tipping point back at the start of 2022 and an inflection point, in other words, a period where starts began to follow it in the spring of 2022. Now, we designed this index so it tracks the red line, which is single family starts. And you can see single family starts has followed the HMI. So we're seeing weakness in single family home building. Single family permits for the first half of 2022 were down 6% compared to the first half of 2021. So the permitting has already slowed. And when we plug in all the macro data that I walked you through, our interest rate forecast, our builder sentiment survey that you see on this slide, here's our now revised forecast for single family home building. And as I said at the beginning, this is the big change from the outlook that I provided this organization back in April. At that time, we were looking for fairly weak, almost negligible declines for single family home building in 22 and stronger declines in 23. What we've done is we've moved it all forward. So for 2022, we think the back half of the year is going to be particularly weak, and that's going to leave on net about a 13% decline for single family starts when we compare 2022 to 2021, which was the best year since the Great Recession, with more than 1.1 million single family starts. That weakness is going to continue into 2023 with about an 8% drop in that year, but the back half of 2023 should begin to see some stabilization and recovery. It's still going to be weak, it's going to be off trend, and then by the time we get to 2024, we think the Fed will essentially have lifted off the brake, causing interest rates to not just stabilize, but even post some declines. I showed you the interest rate forecast earlier, and that's probably going to push us by the time we get to 2024 back to the long run trend. And if you look at this slide, you can basically see the story in the line itself. From 2011 to the end of 2019, we had this kind of sluggish, sort of disappointing recovery from the Great Recession, but it was pretty predictable. Then 2020, you get a drop during COVID, a rebound in the latter part of 2020, real strength in 21 and 2022, or running through 2022. And then at the start of 2022, a drop back below that trend. And then ultimately over the coming 2 years, 3 years, we get back to that trend line. How much housing do we need to build to kind of maintain equilibrium with population growth, second home demand, and replacement housing? It's about 1.1 million. So that rebound that we've got in 2024, still below 1.1 million, means that we should continue to grow into 2025 until we get to about 1.1, 1.15, and then kind of level off. And that's kind of our medium-term forecast in terms of single-family home building. In terms of the geography of where construction is taking place, all 10 of the highest volume markets are in the South, if we can count Phoenix as a southern city. And you can see a lot of them right now are posting declines for the first half of 2022 compared to the first half of 2021. But still worth noting, 3 of the top 5 are in Texas and 3 of the top 10 are in Florida. So this is a lot of Southeast and Texas related growth. That's simply where the population's going, and that's where single family home building has trended. We saw some equalization in the large metros and the small metros as the shutdowns ended, as the kind of the COVID rules went away, and we saw a return to work, particularly in the largest metros. That was a reversal of the early COVID period when a lot of growth for home building shifted out to the suburbs, shifted out to the exurbs, and shifted out to medium-sized cities. Well, now that growth rate is beginning to grow again, and the reason why is that higher interest rates are having a bigger impact, bigger negative impact on these larger metro areas that are higher cost. So the counties in blue here are large metropolitan areas, the core counties, inner suburbs. They represent about 16.5% of single family construction. And over the last year, they've posted about a 7% decline on average. Now that decline is picking up speed. So this number is going to go down fairly rapidly in the coming quarters. But if you compare that 7% decline to these medium-sized cities here in red, represent about 29% of single-family home building, they're posting only about a 2% decline. Now, why is that? Higher interest rates have a bigger impact on buyers in higher cost markets. So these urban core markets here in blue are seeing a bigger impact on the negative side than these the more affordable markets. And we think that's going to continue. It's these areas in red, they're really kind of the growth areas through the cyclical downturn, and they will also post the biggest increases as we move into the recovery period. Single family built for rent construction, it's about 6% of housing starts right now in terms of built and held by the builder. we think there's another 5% that's sold to investors. So that's a total market share for single family built for rent construction of about 11 to 12%. Historically, this submarket was about 3%. So it's already quadrupled its historical share. As the impacts of higher interest rates continue to price buyers out of the market, we're going to see growth in this subsector when the rest of the single family construction sector posts some gains, or I'm sorry, post losses. Custom home building, bigger homes, more expensive homes, better amenities, more kitchen cabinets, for example. This market should actually be a little bit more stable. This market tends to post market share gains when the rest of the market, particularly spec entry-level type construction, shows weakness. So right now it's about 17% of single family home building. I think it's going to maintain its market share. This particular submarket is more connected to the stock market than it is to interest rates, because these buyers tend to have a larger down payment, higher incomes, and the like. Townhouse construction, I do think in the long run we're going to see gains here, just because lots of communities are looking for ways to build density. But right now it's a fairly small submarket, about 13% of single family home building. And then lastly, multifamily construction. This is the apartment market. I said at the beginning, it's going to post a gain in 2022. All the apartment developers I talked to at the start of the year were really bullish. They're starting to get a little concerned now. The ability to find financing partners appears to be tightening due to actions of the Federal Reserve and its impacts on various kinds of financial institutions. But given the growth in permits, and we think that's going to translate into higher starts, we're looking at about an 18% gain this year for apartment construction, and then a decline next year. Now, the reason for the decline, despite the fact that we got a lot of rent growth and rental vacancies are fairly low, is, actually I'm going to skip ahead. The reason is this slide. The red line is the number of apartments under construction. And you can see where the blue line is beginning to tip over because single family starts are declining. The number of single family homes in blue is actually beginning to go down. The number in red continues to rise. And in fact, there are about 840,000 apartments that are under construction right now. That's the largest number since the 1970s. So at some point, apartment developers are going to look at that construction pipeline and say, you know, there's a lot of supply coming. It's time to pump the brakes. And I think that's ultimately going to yield some declines in terms of apartment starts as we move forward. And then just wrapping up, I like to wrap up with demographics. This slide is a reminder that we still have a pretty good runway for growth ahead for single family home building. The blue line going through the slide is the population profile of the United States. The numbers on the bottom are ages. We've divided the slide into a series of generational boxes. So Gen X is in the middle, and just to the left of Gen X is the millennials. And you know, in their early 30s, that's where the bulk of them are. They're approaching that prime first-time home buying year. So when we think about a rebound in single-family home building in 2024 and 2025, those millennials are really going to power it. So we've got some strong years ahead for single-family construction. But if you think back to that fertility rate slide that I showed you near the beginning of the presentation, the impacts of that are clearly seen for Generation Alpha. And that's the generation after Gen Z. Since we ran out of English letters, we call them Gen Alpha. You can see that that is a small generational group. It's smaller than even Gen X. It's the smallest generation in the American demographics in more than a century. So that is going to result in some weakness, particularly in the rental housing market as we move into the 2030s. But as long as those millennials are moving through their 30s, early 40s, and ultimately their 50s, the new construction single family building market will snap back and see fairly strong rebounds when the Fed stops pressing the brake on the U.S. economy. Again, we think they will begin to slow up that process early 23, and by the time we get to 2024, we'll be looking for some declines. So as I said at the beginning, I'll make sure that Mike and Betsy and the staff team at KCMA get a PDF copy of this deck that they can distribute. My email address is on this slide, as is my Twitter name at Dietz_econ, and ionhousing.org. If you're interested in any of this data, everything but the forecasts is available on ionhousing.org. It's our economics blog, and you can subscribe to it by email. And with that, I think I will turn it back over to Mike and see if we've got any questions in the chat box. I'm happy to take questions on. I didn't talk a lot this time about policy of the elections, but policy in the elections, the housing market, the Federal Reserve, inflation. Mike, do we have any questions?
Yeah, and just if people have questions, I don't know that the chat's working properly, but the Q&A box is. And if you also have questions that you think of later and you want to email them to me, everyone has my email address, they should. We can pass it on. But yeah, so here's a question for you. And I know you touched on this with some of the slides, but kind of broadly, are there regions in the U.S. that are going to be having a higher decrease in housing starts and what areas are going to be more steady?
Yeah, so the areas that are going to see the largest declines from this cyclical weakness, right now we're seeing a lot of it in the mountain states. So a month or a month and a half ago, I was in the Denver market. There were some really ugly numbers from builders in that market. And I think this applies to Fort Collins and parts of Utah. It certainly applies to Boise, Idaho. Boise, Idaho was one of the hottest markets. It actually got into our top 20 least affordable markets. It was a strange list. It was 16 California cities, with San Francisco and Los Angeles as the least affordable. Honolulu was in the mix, and Boise, Idaho. Well, that's a bad sign. That was a sign we would see price declines and slowing of builder production. So I think markets like Denver, cancellation rates on new home sales, 40%. Almost all builders are using some kind of price incentive or price cut. Those markets are going to slow. So the really hot mountain states, now they will get back to trend and growing, but it's going to require a reset as we move forward. For stability, so interesting. I like to think of some of the core Midwestern markets as a little more stable. What I mean by core is not the smaller parts of the Midwest that are losing population, small towns, or some of the cities that really act more like East Coast cities, but places like Columbus, Indianapolis, which has been a very strong market, Kansas City, St. Louis, kind of the I-70 corridor. Just last week, I was in Iowa City, Grand Rapids, Des Moines. Those kinds of cities look like they're in a little more stable position. They're less responsive to interest rates. You have population growing in those medium-sized Midwestern cities. And so I think they're going to fare a little bit better. But to be clear, across the board, we're going to see declines in activity due to this increase in interest rates. It's just simply unavoidable. And frankly, it's what the Federal Reserve wants. It wants to slow down some of the sources of inflation. And they saw a lot of them coming out of an overheated housing market. Okay.
Next question is, when do you think the 3.9 million underbuilt housing situation for Freddie Mac will come to zero?
Yeah, great question. So this is my friends, Sam Cater, the chief economist of Freddie Mac, and Len Kiefer, who also went to Ohio State for his PhD like I did. This is their estimate, 3.9 million or so of underbuilt housing, the size of the housing deficit. Now, there's a lot of debate over how big this number is. The realtors say it's 5 to 8 million. Fannie or Freddie Mac says it's near 4 million. NAHB, we believe it's close to 1 million. I think John Burns and Zonda have a little slightly higher numbers, but kind of in this 1 to 2 million range. And then the one outlier is Ivy Zellman, who thinks there's a housing surplus. All right, so the question is, regardless of the size estimates, let's use 1 million because that's the one that we estimate. When do we think it'll come down to zero? I think it's going to take about a decade. I don't think we're going to get to the kind of the equilibrium level. In other words, building enough housing for just the emerging demographics until 2025. And then between 2025 and 2030, we'll reduce that housing deficit probably by about half, get down to about a 500,000 shortfall. And then the early 2030s is going to be a little more challenging to reduce that deficit. So it's going to be with us for some time, which means we're always be skirting the edge of housing inaffordability over the next 10 years or so.
All right. And just real quick, I'll give just want to reiterate something Robert said. iownhousing.org is a fantastic blog and site. So definitely subscribe to that. You get a lot of great information. A question, sort of a trend, that question, you see a lot about tiny houses and people living in their vans and TV shows, but every time you look up and see a house being built, it's gigantic. So that's not really a trend, or is that a trend?
No, it plays well on certain media and on TV, but the tiny house movement is really an offshoot of manufactured housing, or mobile homes as we used to call them, but manufactured housing. And in total, that's about 120,000 units a year. And 99% of that is traditional manufactured housing. It gets in the media because people like to show cute tiny houses. It's not a realistic option. Now, where there is a place for tiny homes is not the traditional method of supply, but what we call ADUs, accessory dwelling units. And that's basically where someone's building an apartment into an existing owner-occupied home. And it could be a separate structure like a garage or a shed. It could be an attic or a basement, but basically where you're building in a small apartment into an existing home. You see a lot of this in California as freestanding structures. You see it in the East Coast and the South in terms of building out what maybe used to be called a mother-in-law suite. We abandoned that term, fortunately, but thinking about it as an ADU. Now, why do I mention that? There is a lot of supply of that. Remodelers undertake those projects. In fact, about a fifth of remodelers work on those kinds of improvement projects. And then if you take the Freddie Mac housing deficit number that was mentioned by Greg in terms of the 3.9 million, one of the reasons for the difference between the Freddie Mac number of just under 4 million and our housing deficit number of 1 million is we count the 1.5 million ADUs that have been added over the last decade as housing units. Are they perfect substitutes for an entry-level single-family home or a townhouse? No, but they are housing people. And so that tiny home movement is really more of an ADU movement. It just gets a lot less attention in the media.
All right, last question. From whether it's an economist standpoint or an investor standpoint, how do you kind of balance what is a growth in cabinet sales and assuming home sales versus the increased costs and delays in shipping? So the sales seem to be going way up, but the profits aren't necessarily going up at the same. They may be very small compared to what the sales are.
Yeah, I had a smaller builder who also does remodelers who said, I never worked so hard for so little money. The idea of he had tons of demand in front of him, lots of inquiries, but because of higher costs, the profit margins were being compressed. And he actually told that to members of Congress because they wanted to know, if we do X or Y, it'll just eat into your profits. And he had to explain to them, look, our profit margins have already been compressed. So I think if you're thinking about from an outlook perspective, I think we're seeing some improvements in the supply chains. We're starting to see some reductions in some of those business-related cost pressures. But I think everyone should be cautious. And I think that caution should really extend through the end of 2023. The remodeling market should remain solid. Multifamily is doing very well. But we are seeing this weakness in single family. It is significant to the extent that we're going to see a drop in more than 10% in terms of single family home building. And then of course, that's going to have spillover effects in all the sectors that work with builders. I would include, cabinet manufacturing in that list.
All right, great. That seems to be the question. So just want to say thank you, Robert.